This is a flame. Specifically, it's the pilot light on a gas boiler in a Berlin apartment building, a small blue tongue of fire that has burned continuously for 11 years. The tenant who lives there pays €127 per month for heating, up from €43 before the war. She doesn't think about where the gas comes from. She just knows the flame stays lit, the radiators stay warm, and winter remains survivable. That flame is connected by 4,200 kilometers of pipeline to a processing facility in Yamburg, Russia. The gas feeding it was extracted from permafrost, compressed, transported, and delivered through infrastructure that took 30 years to build. And on January 19, 2026, Vladimir Putin signed a decree that begins the process of making that infrastructure irrelevant, not by destroying it, but by building something larger in a place Europe cannot reach. Federal Decree 2026-0044 formally establishes Russian sovereign authority over 1.4 million square kilometers of Arctic continental shelf, encompassing gas reserves that dwarf everything currently connected to European markets. The document is 340 pages of legal language asserting rights that international law does not recognize. It was published at midnight Moscow time, in the dead of a January weekend, with no advance notice to any foreign government. By Monday morning, Russian naval vessels had established patrol perimeters around extraction sites that were previously classified as disputed. By Monday afternoon, the first drilling equipment had departed Murmansk, and by Monday evening, European energy ministers were convening calls to discuss a reality that official policy had spent 3 years pretending wouldn't arrive. Here's what they're not telling you. The Arctic contains approximately 1,670 trillion cubic feet of natural gas, roughly 30% of the world's undiscovered reserves. Of that, an estimated 70% lies beneath waters that Russia has historically claimed but never formally annexed. The 2008 Ilulissat Declaration, signed by all 5 Arctic nations, committed signatories to resolving overlapping claims through the UN Commission on the Limits of the Continental Shelf. Russia's January decree abandons that framework entirely. The specific formations covered by the annexation read like a catalog of superlatives. The Stockman Field, 3.9 trillion cubic meters, the largest offshore gas deposit ever discovered. The Leningradskoye structure, 1.8 trillion cubic meters, enough to supply Germany for 40 years. The newly surveyed Kara Sea formations, estimated reserves exceeding 6 trillion cubic meters, with geological characteristics suggesting even larger undiscovered deposits nearby. Gazprom's development timeline, outlined in internal documents obtained by Reuters, shows first production from expanded Arctic operations by late 2028. By 2031, Arctic output is projected to reach 180 billion cubic meters annually. By 2035, Russian Arctic gas alone will exceed the total volume that Europe imported from all Russian sources at the peak of dependency. At 7:30 a.m. Moscow time on January 20th, the icebreaker Sibir departed Sabeta terminal with a convoy that satellite imagery identified as including modular LNG processing equipment. The convoy's heading pointed toward coordinates in the Kara Sea that correspond to no publicly announced development project. Commercial satellite operators reported being asked by government clients to delay publication of imagery from the region for 72 hours, a request typically associated with military operations, not commercial drilling. This is the posture of a nation executing a plan, not announcing one. The announcement was a formality. The execution began months ago. This is where the lie becomes unsustainable. Europe's energy strategy since 2022 has rested on a single assumption, that Russian gas dependency was a choice that could be reversed, and that reversal would permanently diminish Russian leverage over European energy security. The policy was called diversification. The implementation was called Repower EU. The promise was independence by 2030. The promise was always a fantasy. Not because renewables don't work, they do. Not because LNG can't replace pipelines, it can. The fantasy was the timeline and the mathematics beneath it. European gas consumption in 2025 was 340 billion cubic meters. Domestic production, primarily from Norway and the Netherlands, provided 85 billion cubic meters. LNG imports from Qatar, the United States, and Australia provided another 130 billion cubic meters. The remaining 125 billion cubic meters came from a combination of demand destruction, efficiency improvements, and industrial closures that have been reframed as structural adjustment. That 125 billion cubic meter gap is not a transition. It's a wound. German industrial output has declined for 12 consecutive quarters. Chemical production, the backbone of European manufacturing, has fallen 19% from pre-war levels. Energy-intensive industries that relocated to the United States or Asia are not returning because the cost differential is not temporary. It reflects permanent infrastructure realities that no policy can reverse on relevant timelines. Russia's Arctic development doesn't threaten Europe's current gas supply. That supply was already severed. What it threatens is Europe's ability to ever restore affordable energy access, even if political conditions change, even if sanctions lift, even if future governments pursue rapprochement. The gas that might have flowed to Europe through existing pipeline infrastructure will instead flow to Asia through new LNG terminals and the Northern Sea Route. The customers that Europe assumed would remain available as backup will sign long-term contracts with Russian suppliers, offering prices that European buyers cannot match. The leverage that came from being Russia's largest customer will transfer to China and India, who are willing to buy what Europe refused. The trap isn't closing. It closed years ago. What's happening now is the construction of a permanent barrier across the exit. When institutions do this, they're not managing risk, they're containing disaster. On January 21, 2026, the European Commission's Directorate General for Energy convened what internal communications describe as a strategic reassessment workshop. The meeting was not announced publicly. No press credentials were issued. But attendance lists leaked to Politico Europe show representatives from every major European energy company, 3 central banks, and the European Central Bank's Financial Stability Division. Central bankers do not attend energy workshops unless energy has become a financial stability issue. The workshop's briefing materials, portions of which have been reported, include scenario modeling showing European industrial electricity prices remaining 40 to 60% above 2019 levels through 2040 under all plausible supply configurations. The models assume successful renewable build-out, successful LNG terminal expansion, successful demand reduction, and successful efficiency improvements. Even with all 4 succeeding, the cost gap persists because the marginal supply source has permanently shifted from Russian pipeline gas to globally traded LNG, and LNG prices are set by Asian demand. The financial stability implications cascade from there. European manufacturers competing against American and Asian producers face permanent cost disadvantages that compound annually. Investment flows toward regions with lower energy costs, depleting the capital base needed to fund the transition. Tax revenues decline as industrial activity contracts, constraining public investment in the infrastructure required to achieve independence. Less than 36 months remain before Russia's Arctic production reaches volumes sufficient to influence global pricing. Once that capacity comes online, Russia regains the price-setting power it supposedly lost when Europe stopped buying. The difference is that this time, Russia won't need European customers to exercise that power. Asia will absorb every cubic meter Russia can produce, at prices that reflect Asian willingness to pay rather than European ability to afford. The European Commission's official position remains that diversification has succeeded and energy security has been restored. The workshop materials tell a different story. Energy security has been replaced with energy survival, and survival comes at costs that will reshape European economic geography for a generation. While one side struggles, the other side builds. China's response to Russia's Arctic announcement was coordinated with a precision that suggests months of advanced planning. Within 18 hours of the decree's publication, CNOOC, China National Offshore Oil Corporation, announced a $12 billion investment in Arctic LNG infrastructure, including 3 new tanker vessels specifically designed for Northern Sea Route operations. The tanker specifications are significant. Ice-class Arc-7 vessels, capable of year-round Arctic navigation, cost approximately $350 million each, 3 times the price of conventional LNG carriers. China is building 14 of them. No other nation has ordered more than 2. The investment only makes sense if China expects Arctic gas flows to become a permanent feature of its energy supply, not a temporary arrangement subject to geopolitical revision. India followed with its own announcement, a 20-year supply agreement with Gazprom for 8 million tons of Arctic LNG annually, with pricing indexed to Indian domestic benchmarks rather than European spot markets. The agreement includes an option for Indian participation in upstream development, equity stakes in the gas fields themselves, rather than mere purchase contracts. The Northern Sea Route makes these Asian partnerships economically superior to any European alternative. Transit time from Yamal to Shanghai via the Arctic is 19 days, compared to 35 days via Suez. The cost differential at scale exceeds $3 per million BTU, enough to make Russian Arctic gas consistently cheaper for Asian buyers than any competing source. Russia has invested $32 billion in Northern Sea Route infrastructure since 2020. Nuclear icebreakers, search and rescue stations, deep water ports, and navigation systems that extend the shipping season from 4 months to 8. Western analysts dismiss this spending as prestige projects disconnected from economic reality. The Arctic annexation reveals it as the foundation of a reoriented energy export system that bypasses Europe entirely. By 2032, the Asia-oriented Arctic system will have greater capacity than the Europe-oriented pipeline system ever achieved. Russia will export more gas than before the war, to customers who pay promptly, without sanctions risk, and without the political complications that European markets created. The punishment that Europe intended to inflict has instead accelerated Russia's diversification into markets that will prove more durable and more profitable. This is not about one energy source or one customer base. This is about the permanent restructuring of global gas flows around a system that excludes Europe by design. The mathematics of the trap are now inescapable. Europe's strategic options have narrowed to 3, and all 3 lead to variations of the same outcome. Option 1. Accelerate the transition. Build renewables faster, deploy storage at scale, develop green hydrogen as an industrial feedstock, and accept that the transition will cost more and take longer than projections assumed. This path requires 3 to 4 trillion euros in investment over 15 years, sustained political commitment across multiple electoral cycles, and acceptance that European industry will operate at a cost disadvantage throughout the transition period. The path is viable but painful, and the pain is front-loaded while the benefits are back-loaded, a political configuration that democracies struggle to sustain. Option 2. Find alternative gas. Expand LNG import capacity beyond current plans. Develop East Mediterranean reserves that have been stalled by territorial disputes. Pursue North African partnerships that previous governments abandoned for human rights concerns, and accept that alternative gas will cost 30 to 50% more than Russian pipeline gas cost before the war. This path preserves gas-dependent industries, but at margins that make long-term competitiveness questionable. Option 3. Accept deindustrialization. Allow energy-intensive manufacturing to relocate to regions with lower costs. Restructure European economies around services and high-value production that can absorb elevated energy prices, and redefine energy security as sufficiency rather than abundance. This path is already underway, not as policy, but as the accumulated consequence of decisions made and avoided since 2022. The trap is that none of these options restore the status quo ante. The Europe of 2019, industrial powerhouse, largest gas market, price setter in global energy trade, cannot be reconstructed. That Europe depended on Russian gas flowing through pipelines that no longer function, at prices that no longer exist, under relationships that no longer hold. What replaces it will be smaller, more expensive, and permanently constrained by energy costs that competitors do not face. Russia's Arctic development doesn't cause this outcome. The outcome was determined when the pipelines were severed and the relationships ended. What the Arctic development does is foreclose the possibility that future reconciliation could reverse the damage. The gas that might have restored European competitiveness will flow to Asia instead, under contracts that extend decades into the future, through infrastructure that physically cannot serve European markets. This is what a system looks like when the road back has been demolished while you were looking forward. The informed are not waiting for official announcements to understand what's happening. European natural gas futures show persistent contango through 2030, prices for future delivery consistently higher than spot prices, reflecting market expectation of sustained scarcity rather than normalization. The curve structure contradicts official projections of falling prices as renewable capacity expands. Markets are pricing in a different future than policy assumes. German industrial electricity forwards have reached 142 euros per megawatt hour for 2027 delivery, 3 times the 2019 level, and incompatible with positive margins in aluminum smelting, chemical synthesis, or steel production. These prices represent contracts already signed by industrial buyers who need certainty for planning purposes. The factories covered by these contracts will operate at a loss or close. Physical gold demand at German dealers has increased 31% year over year, with the largest growth in denominations suitable for portable wealth preservation. This pattern, accumulation of physical assets by retail buyers in a country with strong institutional stability, historically precedes currency concerns that official confidence metrics don't yet reflect. The spread between paper gold contracts and physical delivery on European exchanges has widened to 4.1%, double the spread in Asian markets, and a signal that European buyers are paying substantial premiums for atoms over digits. When populations lose faith that paper claims will convert to physical assets, they pay whatever premium is necessary to secure the physical assets directly. Central bank gold purchases across the Eurozone have quietly accelerated. The Bundesbank added 37 tons in 2025, the largest annual increase since reunification. The Netherlands, Austria, and Belgium have made smaller but proportionally significant additions. Central bankers don't publicly explain gold purchases, but the pattern speaks to institutional hedging against outcomes that official statements don't acknowledge. The question is not whether Europe faces permanent energy cost elevation. The question is who understands that elevation's full implications for industry, for investment, for currency stability, and for the political arrangements that assumed prosperity would continue. A pilot light in a Berlin apartment, a flame that has burned for 11 years, and a decree signed at midnight that ensures the gas feeding that flame will never again flow at the price that made European industry competitive with the world. This is not an energy policy. This is the geological redistribution of economic power, hydrocarbons flowing to customers who will pay, away from customers who cannot. Physics doesn't negotiate. Molecules don't respect sanctions. And reality, eventually, asserts itself over every strategy that assumed yesterday's infrastructure would remain available tomorrow. The divergence between Europe's transition plans and the physical gas flows that might have eased that transition has become permanent. What happens next is not prediction. It's 1.4 million square kilometers of Arctic seabed that Europe will never access, feeding markets that Europe cannot compete with, at prices that Europe cannot afford.